When you think of great investors like Warren Buffett, there's a kind of track record and a systematic approach that they do use. In today's video, we're going to be looking at 9 ways to invest like a pro so you can see those sweet gains that they get. Starting with number 1, thinking long term. Now, again, using the example of Warren Buffett, he invested over, I believe it was 60 plus years to get his billions and almost trillions of dollars at some point with Berkshire Hathaway. But thinking long term is the way that you need to invest. When you start looking at your 401k plans, when you look at your Roth IRAs, even investment strategies and brokerage accounts, it is long term. Now, there are a couple different reasons for this. Number 1, the short term when it comes to stocks don't make a difference. If you're day trading, yes, it's going to. If you're looking investing, 10, 20, 30 years down the road, long-term investing is just that. We're looking at a time frame of 7+ years of investing in the market, which means even if you look back, I don't think there was a period where we had 7 years that were down years every single year. Now, in addition, thinking like an owner that you own the company that you're investing in. For me personally, I invest in ETFs like the VOO, the S&P 500, and really thinking like an owner, making sure that you're reducing your capital gain taxes by keeping and holding those investments and improving your overall return from this. Now, of course, massive long-term winnings when you look at Apple, when you look at Amazon, when you look at Tesla, when you look at those Magnificent Seven stocks, they not only make up a big chunk of the market, but again, when you look back over the last decade, their gains have been incredible. And if you were in there, you would have made an incredible amount of money through the compounding interest. Now, of course, Charlie Munger has said the first rule of compounding is never interrupt it unnecessarily, which means if you have that compounding interest in that portfolio, just keep it going forever. Number 2, Warren Buffett says, don't lose money. This is the top investing rule. If you ever have a second chance or forget what rule 1 is, rule 2 is don't forget rule 1 and don't lose money. That is right. If you're investing, and this is a really solid approach, if you're putting money into the stock market and the stock market is down 20%, you still own the exact same amount of stock. So the relative price may have changed. The stock ownership and the ownership of the company did not change. Your position did not change. Now, the only way that you can change this position is if you actually choose to sell. So if you go ahead and sell that, you will take your 20% loss. Whatever is left, your initial investment minus the 20% that you lost, that is your gain. So what does that mean? It might take 3 years, it might take 5 years, it might take 7 years before that is profitable when it is up. So let's say, again, you put in a X amount of dollars. In the next course of 5 years, it's up 20%. When you take that money out, you're gaining the 20%. Now, I know there is inflation aspects. There's a lot of variables in there, but overall, not losing money. If there is no potential upside to an investment, just don't invest in it, guys. If you really don't feel right for the company, if you don't really, and this is the reason why I don't invest in personal stocks, individual stocks, is because the probability of something going awry with the company, you could have one company that does well and really performs exceptionally well, but you could also have the same scenario where one company doesn't do as well or does incredibly poorly that you invested in. This is the reason, again, why I do ETF investing, making sure that it's spread across the market. Number 3, seeing what other investors are investing in. That is right. When you look at a lot of places, where are the greats? Where are the Warren Buffetts of the world really investing? What are they buying? What are they filing? Now, of course, they do have to file just like everyone else. It's a Form 13F for the SEC when they invest more than $100 million in assets. So if they're putting and moving money into things, there's a reason that they're moving the money, and you should really probably follow suit or at least pay attention. Again, for a majority of us, I don't have time to watch individual stocks. I'm not looking to time the market. I'm looking to do regular investments through dollar cost averaging and just really churning that and letting it grow. So far in the last 2 years, if you checked out my $1,000 a week portfolio video, we are up around 56% as of today, which is kind of crazy in the last 2 years that we are seeing that kind of growth. Number 4, building an investment community. That is right. You can get with like-minded people that have very common interest to you. Now, of course, with the internet, with social media, with Discord, with a lot of different places you can follow investing, you can build a community of investors that are going to have like-minded ideas, sharing your own ideas, kind of bouncing even those ideas off different people, different investments, different companies, different ETFs, longs, shorts, whatever it may be. You have a group of people to kind of bounce those ideas off, if they're good, if they're bad. Now, of course, you do have to verify exactly who you're kind of dealing with and what their knowledge base is. So me, I have a very solid fundamental when it comes to investing. Even, through my years of working with different financial investors and financial advisors, we've kind of come up with a pretty good portfolio that works. And even I've developed a few that they've looked at and said, yes, it looks good. I would definitely invest in it. I know there's a lot of YouTubers that kind of do the same, but again, you have to be very cautious with who you're building and who you're letting in the community. Number 5, look at underperforming sectors, stocks, or assets. Depending what you look to invest in, a lot of people, will have the buy, the sell. If you're watching Kramer, if you're seeing a lot of different things, on CNBC, or you're looking at Fox, whatever it may be for your source, when you're looking at the highs and the lows of where a company is performing, really understanding why they're performing like they are and exactly where it is coming from. For instance, when Tesla, is down 10-15%, there's a reason. Their earnings came out, they didn't sell as many cars as they were thinking, or there could be a bunch of different things. Now, of course, there are a lot of really fundamental economy things that can happen when they're rising rates, things of that nature. But fundamentally, a majority of the companies, especially if you're investing in, again, let's say the VOO, that S&P 500, it's going to make a big difference because you're invested across all of the sectors, which means your exposure. So even if you have a few companies that don't perform well, some companies that perform exceptionally well, it evens and kind of balances itself out. And with that being said, number 6 is doing your own research. I cannot stress this. Fundamentally, do your own research. You can get an idea from other ones, but it's critical to do your research when you're putting your money into it. Now, I am not a financial advisor, so this is all for really research purposes. Making sure, I know people that do penny stocks. I know people that kind of day trade that have lost a ton of money, especially when it comes to the crypto market, investing what some people were telling them to invest in. Unfortunately, that investment went south and they lost a tremendous amount of money. Do your own research and know where your own risk parameters are really at. That way you know exactly what you're happy with. Essentially, if you're putting money into the stock market, there's a chance that you could lose money. It is not guaranteed gains. There's a chance that you could lose money. You have to be okay with not only the long-term investing, but also be okay with losing money if that is the case. Number 7, have your buy list ready. That is right. So when you looked at 2022 with a very, very heavy down market, 22% was about the average that it was down. Some places a lot less, some places a little bit more. But overall, when we start going into a market like that where everything is kind of suppressed and everything is kind of down, that is where a lot of people will put money into the stock market. Again, thinking of Warren Buffett, he said, when everyone is being super greedy, not time to invest. When everyone is panicking and selling everything, that is the time. When there is blood in the streets, it is time to buy, and it is time to buy heavily because people are panicked. When it comes to investing, you have to remove the emotion part of it, making sure that you're investing. And again, the market will overreact to short-term news. It will react to a lot of things on social media, making sure that you stick the course and remember the reasons and really write them down exactly why you're investing in the manner that you are in the portfolio and in the stocks that you are. Number 8, concentrate in your best ideas. So this is really big, spending most of your time exactly how you want to do it. This, of course, there are a few pros and cons that they kind of do with this. Pros can concentrate positions when they're thinking long-term. This, of course, making that long-term focus, 7+ years is what we're looking for the overall strategy. Dollar cost averaging, definitely one that I go ahead and do. Focus on the downside first. So if it's downtrending or if it goes into a buy position, might be something you want to pick up. Have confidence in your own research once you went through and you did all your research, and then you know exactly your portfolio, exactly what you're going to do and what you're going to be investing in. And then, of course, the final one for this, investing in ETFs. Like I've said before, and I've said for actually years at this point, You can buy ETFs that cover, so many different things. You can buy, the QQQM, which is a really good buy that has the NASDAQ 100. You can buy the Russell 2000, the Russell 3000. I believe there's even a 4 or a 5000, which encompasses a lot of different companies. You can do the S&P 500 funds. There are so many different ways that you can cut ETFs. You can even go in there and purchase specific sectors. So if you just want exposure, let's say to technology, there are going to be sectors that are just covering technology. A lot of people are also buying semiconductor ETFs with the rise of, cars, electronic cars, the EV movement, also looking in conjunction with artificial intelligence. There's a lot of different ways. There's also blockchain ETFs if you want exposure into blockchain cryptocurrency technology. Again, there are so many things out there. Do your research on exactly what you're putting your money into and make sure you know your risk tolerance before you're getting in there. So bottom line, guys, looking at the 9 ways to invest as a pro, definitely the long term is really the big ones. If you're doing your research, if you're investing in an ETF that you're going to hold for the next 7 years, making sure that it is diversified across the different sectors, and you will see growth. I guarantee there will be growth within that portfolio within that time frame. That's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.